Good afternoon, everyone. Welcome to M2 Financial's Market Update and Portfolio Perspective. I'm Michael Matheson, and very thrilled to have you all here with us today. Thank you so much for taking some time out of your busy lives to join us. We've got a nice little lineup here. We've got some special guests with us today. But before I dive into that, I'm going to just read something that our compliance department loves for us to read. So content in this material is for general information only and not intended to provide specific investment or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. All investing involves risks, including loss of principal. No strategy assures success or protects against loss. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. So there we are. So again, welcome. I'd like to introduce the folks that are with us today. Again, I'm Michael Matheson with the M2 Financial Group, and we've got Scott Robichaud with us, an advisor on the team, as well as Susan Anderson. We've got some special guests actually with us as well from Janus Henderson, Dan Spenny. Dan has been with Janus as long as actually I knew you before that, Dan, didn't I? We've known each other a lot of years. So Dan represents Janus locally and has been a big part of helping us develop our strategies over the years. And we also have from Janus Henderson, Michael McNurney. Was very glad to have you, Michael. Michael's in Houston, and glad to have you as our special guest today. He's an executive director and investment strategist at Janus Henderson Investors. In this role, he's responsible for articulating Janus Henderson's view on equity markets, the macroeconomic environment, and how the firm's suite of equity products are positioned within the investment marketplace. So thank you all for being here with us today. In acknowledgement of really what's been going on out there in the world, that's why we're doing this today. And we're really fortunate to be able to bring in special guests like this because these are the folks that when we have questions, when we have thoughts, when we're formulating strategies, investment strategies, these are the conversations that we get to have. So to be able to call on the experts and have them live with us here today, we're still very fortunate and very thankful that we're able to do that. We've had a lot of market volatility on the downside, and fortunately, market volatility on the upside as well, which has increased questions that we've been getting from clients. And we know just based on who's with us today that a lot of you have been very awesome at asking questions. We also know that if you haven't asked the questions, they might be on your mind. So that's why we're here today to cover a whole bunch of information for you. So if you do have questions along the way, feel free to use the chat feature with our Zoom, and we'll try to get to as many questions as we can. So that all said, again, thank you all for attending, and we're going to start just with a question for you, Michael. So the questions that we get from our clients are very similar to this. So based on what's happening, could we just start with a broad overview of recent market performance and the volatility, some of the key things happening out there?
Yeah, absolutely. And Mike, thanks for having me on. I really appreciate the opportunity to talk to your clients. I guess we have to start with the elephant in the room, which is just the persistent economic uncertainty. I recently did a panel on Monday, as a matter of fact, and they essentially made me confess all the things I don't know, which was a lot. And I think that is a common theme across most economic prognosticators. The underlying economy, however, remains really resilient. We get some mixed data sets naturally driving the market volatility and some client unease, as you mentioned. But probably the biggest thing to pay attention right now is just some of the inflation realities that we're facing right now. The CPI inflation ticked up to 3.3% year over year as of the end of March, which is a little bit higher than we initially anticipated, but that really was just a consequence of the conflict that's happening in the Middle East right now. And the recent bump is really heavily driven by the energy sector, where energy prices overall jumped about 12.5% in the last 12 months, and gasoline prices, which I know we're all feeling, has risen by almost 19% over the last year. So the silver lining, I guess, in that respect is core inflation, which core inflation strips out some of the more volatile food and energy costs, core CPI was notably lower at 2.6%, indicating that some of the underlying, I guess, long-term price trends are actually a little bit more stable than the headline numbers suggest. Because of that, the Fed has a dual mandate. They think about both inflation and they think about the Federal Reserve, sorry, thinks about inflation and unemployment. They're going to most likely leave the Fed funds rate at the same level. So we're not at the beginning of the year, we anticipated several rate cuts, which would have stimulated economic activity because of inflation. They're going to take a more conservative approach. And right now, the effective Fed funds rate is at 3.64%. Our institutional research says the Fed is likely to hold rates steady for the remainder of 2026, provided that the labor markets remain somewhat strong. Right now, economic forecasters are currently projecting U.S. real GDP somewhere between 2.2 and 2.5%. So that's healthy as well. And unemployment, it remains historically stable at between right around 4.5%. So from an economic standpoint, despite the fact that it feels like with a conflict overseas, despite the fact that there is so much uncertainty about economic policy here in the United States, markets have reacted very strongly. And typically, when there is so much uncertainty, markets get a little bit more conservative, but the underlying power that's happening aside from just economics is two things. Number one, we have these extraordinary, what we call secular drivers or drivers that don't have an underpinning in the economy. Think things like artificial intelligence, healthcare innovation, etc. The other piece that we have is that earnings growth amongst companies remains very strong. And ultimately, the stock market, it follows earnings growth. And earnings growth this year for the S&P 500 is estimated to be over the last 2 years, so right around 16%. That's really healthy for the year. So, Mike, unfortunately, there's a lot that we don't know, but the economy isn't reacting to the conflict in the Middle East the way that I think some people, especially if you tune into news programs, might lead you to believe. And markets have been remarkably resilient during this period of time.
Yeah, and that's, it's funny. You mentioned the media. It certainly seems as if which is typical, when things are bad, the media is singing the Don Henley song "Dirty Dirty Laundry," and when things are good, we're just not hearing about it as much. I told clients that as we're approaching record highs in the S&P and crossing the threshold again, that it was happening, and they said, "What? What are you talking about? I've got no clue." So we always hear the media noise when things are kind of at the darkest hour, and when things start to pick up, it seems like that noise tends to fade away, and we don't hear about it as much. In fact, we had some client reviews that they did not take a statement vacation, as we sometimes say when things are rough, and looked at their quarter statements, and 2 weeks into the quarter, they're just wait, what happened here? That's not what my money was worth. I'm like, well, hang on till tomorrow. So you see what tomorrow brings. With what's going on with the war right now.
Hey, Mike,
Obviously something.
just
Yeah.
one other thing that I just wanted to mention. I think it's remarkable because I think when you watch television, you're right, there's a lot of agenda-driven news, number one, but I think also there are people like me who go on to a TV program and you're asked about things like the economy, for example, and the answer that I gave you just a moment ago, it's very factual and there's no agenda behind that. But for people in my position, they tend to be a little bit more bearish, so a little bit more negative on markets. A, because it makes them sound smarter. But B, I think, if you're right, then you're right. And if you're wrong, everybody's happy because the market is doing well. So there is a little behavioral bias that comes along with a lot of news. And I think it's why your clients have you and Scott and Susan to be able to get the straight information instead of just what they're hearing in the news. And that's incredibly important that you're paying more attention to your advisor and less attention to some of the headlines.
Oh, that's great perspective. That's awesome. There's a couple of firms that I followed for literally decades that are mega bears. That something's always wrong, always wrong, always wrong, and they tend to get the headlines. They're out there up front when things get a little rocky out there, and they're just hoping to be right because every 6 or 7 years, they're right, and they get the headlines like, all right, look what I called this bear market. I've been calling it for years, and yeah, you're going to catch one once in a while. What do you think with the war? We've got all kinds of things going on, daily changes with the news and this type of thing. How do you feel with everything that's going on, where this thing will end up with escalation, de-escalation, those types of things? What do you guys think is?
Well, I guess number one, we think about it more from a company by company, investment by investment level. So trying to determine which companies have some real potential impacts, whether that's just rising fuel costs or that is direct implications of the Strait of Hormuz being closed. But overarchingly, unfortunately, I have the sneaking suspicion that, we probably are looking at escalation before the Iranian regime begins to back down. And there seems to be a split amongst the Iranians. Their military leaders are unlikely to capitulate. So we'll have to see which group comes out on top within Iran, but with a pretty solid deadline in place for the end of today. I'm concerned, especially since there were shots fired in the Strait. But again, I think sort of the worst case scenario has already played out in terms of the economic impact, which is the Strait is closed. Ships aren't moving through. 20% of the world's oil supply goes through that strait. In the meantime, energy prices have only, and it's hard to put that in, air quotes, only gone up 12.5%. If this would have happened 35 years ago, that number would have been substantially higher. So we've reduced our dependency on Middle East oil. It is having an impact on some of the economies that were still accepting Iranian oil. So Russia, China, two of the countries there, but still so much uncertainty. And I think most market participants are looking through some of that uncertainty and considering this a short-term impact. And I think we all say we're long-term investors, and that should certainly be the case. And so yes, we have this short-term disruption to the oil supply, which will increase energy prices, potentially increase inflation, which has implications to interest rates, which of course drive the economy in large ways. But it's all relatively short term, and I don't think this is a forever war for certain. But in the short run, it's a disruption to global markets. And I don't know, Mike. I actually came on here because I thought you were going to tell me how this was all going to end. So I'm hoping you
I've
can
got the
give me
part.
the
I've got a piece later that I'll bring up the crystal ball, and I'm assuming you've got yours with you, so that's
excellent.
going to be good. One question that just came in, which
I'm
we
curious, Mike,
appreciate.
though.
Yeah,
Have you guys changed your portfolio positioning as a consequence of what's happening in the Middle East?
no, I think that what you said is ringing true to how we've been messaging with our clients as well. That short term, hopefully that this is a very short term conflict and a blip that will show up on the map, right? Because there was some. I mean, it's a big conflict. It's historical. We're living history right now, and those things always have an impact. But we really stress over the years avoiding any reactive or speculative based on short-term events, and that's a very, very important kind of just credo that we've stood by for the decades that we've been fortunate enough to be able to do this and help our clients.
I think it's interesting because this is the power of having an advisor, because I think we all tend to have this gut reaction to things like war that obviously is tragic regardless of the reasons for the war. And our sentiment becomes very unconstructive in this case because we tend to react sentimentally rather than based on market conditions. And While there is a lot of volatility, I think we tend to think of volatility as a flaw in the market, but really it's a feature of the market. And when you have advisors that can help you be steadfast during these times, or even identify opportunities where there are dislocations from perception and reality, it's such a critical component to staying the course and generating wealth over time.
That's awesome. Thank you. We did have one question come in. I'll read the quote. I can't believe the market hasn't crashed given the things that have happened. And we've heard that many times from our clients. Is the underlying economy really strong, or is this market being propped up by the Magnificent Seven?
What's remarkable about recent performance is it really hasn't been as narrow as it's been over the last couple of years. So the Magnificent Seven are performing well, but you've got sort of a bifurcation of the stocks within the Mag Seven that are some are doing well, some are really struggling. So you look at Microsoft year to date, a company that's struggling despite the fact that they have one of the best business models on the planet. So it's not necessarily that this narrow cohort of stocks is propping up markets. It's more that we're looking at what the market is actually delivering to us. And again, stocks typically follow earnings. If you see substantial earnings growth, that means that the company is healthy and has a lot of options of what to do with those earnings, either returning it to shareholders or investing in their own business. There are several companies, especially what we call hyperscalers, but those large technology companies that are the five hyperscalers, and we can go through those if you're curious, but they're spending $602 billion this year on capital expenditures, investing in the foundational elements of artificial intelligence. That spooked the market earlier this year because it means some of those large companies are going to go cash flow negative in the short run. But again, we're long-term investors. So if we're long-term investors, we look at that and say, eventually these companies will see returns on that invested capital, and that's going to propel earnings and make these companies even more healthy down the line. So earnings growth has been great. It's been much broader than it's been over the last couple of years. So it's not tech heavy and top heavy. And that's resulted in a really strong market. The other piece to this is the US consumer has been so strong. And that's not just a this year thing. It's not just the last couple of years thing, but even through the pandemic, the US consumer remained relatively resilient. And the US consumer specifically is what drives the engine of the global economy. And the US has been incredibly resilient, and we're starting to see signs of consumers outside of the United States becoming much more healthy, and that's driving some really interesting ideas outside of the US.
I've always watched restaurants and retail, and the mall walkers. When things are really tough, mall walkers are out without a lot of shopping bags. I was dragged to a mall recently, so I know this, and it was dragging me to the mall. Yeah, but boy, just the people shopping and buying. I mean, the parking lots were full, the mall was full, and then the restaurant gauge here in Maple Grove, Minnesota, where we are, the self-proclaimed restaurant capital of the state. They're full. I mean, there's people out. There's new restaurants popping up, and people are out and they're utilizing and spending money. So that's what I've always said, Michael, and if you can help me understand if I'm kind of on the target. When big things have happened and consumer behavior has changed, that's when I've gotten worried. When consumers aren't out there doing their thing, when consumers are worried that they might get laid off or worried that there's going to be an impact. That's when I've always gotten concerned, and I just don't see that. I don't see behaviors changing. I don't see any of that shift happening.
No, I think you're exactly right. And I think the other piece to this is, look, if we just focused on CPI, so the consumer price index, so inflation, if we only focused on that, it would be easy for us to panic. But that is one of many things that we're looking at. And I would remind people the market almost always experiences a significant intra-year drop. So I think the historical average over the last 100 years is a 14.5% drop intra-year, but over 75% of calendar years, the market is up. And so we do have these periods of concern, and certainly we saw this earlier. And I would argue that the bigger concern in the market earlier this year was more around AI and the implication to software companies. rather than the war in Iran. Although an extended war would obviously have implications again to inflation. So it, it's easy to forget that the market doesn't always go up. It's easy to panic when you see some of the numbers, especially when they're exacerbated uh, by the talking heads on TV. But again, it's about staying the course. It's about, as you and I talked before this, it's about having a good diversified portfolio. And that's incredibly important, even when the narrative seems to be somewhat negative.
Based on that, you mentioned history. I like to go back and share with clients just, historically after we've had a historic event like this, how the markets just in general performed the next year, 2 years, 3 years after a historical time like we're facing right now.
One of the things that I think is really interesting is every conflict that has begun since 1990, the market is up 8 weeks after the beginning of the conflict. Um, Now, there's one exception, and that was 2019. And I can't tell you what conflict started at the end of 2019, but the market was down 8 weeks later because it was the middle of the COVID pandemic sell-off. But in every case, the market tends to react negatively to the news of a global disruption like the one that we're facing in the Middle East right now. But ultimately, they identify opportunities in companies that are resilient from this. And now, even when we've had significant inflationary pressure, which is the big concern right now, back in late 2021 and into 2022, the market did pull back, but it's recovered from that point. And I think it's behavioral. And I'm in Houston right now, and my hotel is in the middle of a shopping district. So I understand your pain, Mike, of having to go to the mall. But the reality is the short-term implications of this are felt as an investor different than anywhere else in the rest of our lives. And what I mean by that is shoppers out here at the mall next door to me, they're looking to buy things at a discount. And if they're going to sell something, they want to sell it at a premium. And then we get to investing. And when stocks go down, people's natural inclination is to start selling stocks. And when stocks go up and the market continues to rise, we tend to want to buy stocks. And that's the exact wrong behavior. And again, volatility isn't risk, it's opportunity for long-term investors. And so I would look at some of these pullbacks and look at areas of the market that have pulled back unnecessarily and where there's opportunity versus where there's a little bit more risk.
Oh, that's awesome. That's great. Based on what we shared about what's going on today, and based on some of the historic, is there anything that uh, Janus Henderson and your group is suggest, any pivoting or anything like that?
Yeah, Mike, that's a great question. I think there's a couple of outstanding opportunities. Number one, I think there's a reason to invest internationally for the first time in over a decade. And typically, people like me, they'll point to the fact that stocks trade cheaper on a price to earnings basis, um, and that is true, but a lot of those companies have earned a lower stock price. And so it's imperative to be able to look for companies that actually have a catalyst to see improvement in their earnings growth. And that to me isn't just cheap stocks tend to go up or tend to go down less. What it is, moreover, is that the US has really changed our position on stimulating economies outside of the US. We've turned more inward, and that means that countries are going to be responsible for their own economic growth. As a consequence, the companies that are critical to their local economy are going to see substantial opportunity as these countries spend their own money to stimulate their own economies. So, what's a good example? Germany lifted its debt brake in 2025 so they can spend into deficit to stimulate their own economy. And that's not going to help every German business, but those that are critical to their economy. So the automotive industry or the software industry with SAP or the Deutsche Telekom company, all are very critical to their local economy, should benefit from that internal spending of money rather than the external spending of money that's done by the United States, which is much less efficient. So I think international is an opportunity. I think there are substantial opportunities in those secular themes that I mentioned before, and I think AI tends to suck all the air out of the room. But um, the bottom line is AI will be the greatest economic multiplier in history. It'll be the biggest productivity enhancer since the Industrial Revolution, and I can articulate the reasons for both of those things, but it creates a very good long-term opportunity. I think healthcare doesn't get enough credit for the innovation that's happening there. And I recently sat at a dinner after speaking at a conference, and the woman on my right was the CEO of a company that's working on what's called bispecific immune oncology agents. So today, a cancer drug will look at one marker in cells for cancer and then attack that cancer if it's found. Her therapy would look at multiple markers. The guy on my left was president of a company who is working on a new version of GLP-1s, the weight loss drugs, where instead of curbing appetites and people on GLP-1s, they tend to lose muscle mass and then fat. This would specifically target those fatty cells and help change your metabolism so that it's a much healthier weight loss. So the innovation there is phenomenal, and it represents significant opportunity as well. So there are so many places where we have certainty. AI will be the greatest economic multiplier in history. Healthcare is the most innovative sector, no matter what our technology people say. Those are places where I have certainty, and that certainty creates some opportunity.
Awesome. No, that's great. And it's like the international messaging as well. And we appreciate the feedback that you and our other partners have given us over the years, that we've made some shifts, and it's showing. So that's very very helpful with that. I'm looking to see if we've got other
Mike,
questions. Yeah.
sorry, I wanted to mention one other thing, I think, because you got the question about the Mag 7. And the Mag 7 really has been a phenomenal cohort, but there's another cohort that I'm guessing that none of your clients have heard of called the granolas. It's an 11 stock cohort of companies predominantly based, actually all based in Europe, more healthcare companies, more consumer related companies. That cohort of 11 stocks has performed on par with the Mag 7. You just don't hear about it as much because we have a home bias here in the United States, but a lot of those companies have performed extremely well. It has been a bit of a narrow market there as well, but just as good a companies, but again, much less tech heavy and top heavy compared to what you get in the US.
I appreciate the terminology, Michael. The granolas. I'm intrigued. That's awesome. Very awesome. Well, we're right at our half-hour mark right now. Is there any closing comments or other thoughts you want to make sure our listeners and viewers get to hear from you, Michael?
Yeah, and one of the things that we've already talked about a little bit, I think, our portfolios have looked at and really focused on companies that can be resilient through these uncertain economic times. I think the way that that's expressed typically, and I suspect your clients' portfolios, is the power of diversification. And while it's impossible for me to predict the exact moment that energy prices will cool off and the Fed might eventually pivot on rates, wide diversification across asset classes and regions remains the best absolute defense against some of the concentration risk that you get with things like the Mag 7 or the recently mentioned granolas. It's all about time in the market and not trying to time the market. And there's some really remarkable statistics about your returns if you miss the best 10 days in the market. And even when you avoid the worst 10 days, don't permanently handicap your long-term growth in your portfolio by trying to time the market. And again, you've got a great team here with Mike, Scott, and Susan that can give you advice on how to navigate these markets, and I would highly encourage you to utilize that team.
Awesome. Thank you. Thank you. And to everyone that's here, our clients and friends that are considering our services, we are committed. Our commitments to maintain a disciplined investment process with our clients, and the ongoing monitoring of markets and economic developments is what we're fortunate enough to be able to do on the daily. And again, avoiding the speculative moves and trying to guess this thing, because nobody's going to outguess Wall Street. If we could, we'd all be on the beach with doing our day trading thing, and when we can't do that. And know this too, our approach is really, when it comes to the investments are based around our clients and our clients' financial planning. The investments that we make on your behalf and we partner with you to make are for you. They're only you focused and just designed to meet your needs, whether those needs are income needs, long-term growth targets, or anything in between. So we've worked with folks on all ends of the spectrum, from the starters to folks that that have been retired with us for 25 plus years. And it's just everybody's different in what their needs are. So as always, we encourage you to focus on those long-term objectives through these kind of interesting times we're going through. Consistently do what you've been doing, which is reviewing your personal financial plans and liquidity needs with us. And then absolutely, if there's an individual question or concern or comment or whatever you want to make, never hesitate to reach out to us and just let us know. We're always open to any conversations. Everybody here, again, Dan, Michael, thank you so much for taking the time to share your wisdom and your words today on the markets. It's so helpful, and as mentioned, we're very fortunate to be able to share this share what we hear from you directly with our clients, and we really appreciate that. Thank you to all of the folks that came out today to listen to us, and we hope that this provided you some insight and value as to how our thoughts are developed as well. We are committed to client communication and support, and as I've said probably a dozen times already, if anything pops up or you need anything, please don't hesitate to give us a yell or an email or whatever. Thanks to my team and everybody that helped put this together. Scott and Susan were here with us. And Dan, did I mention you, Dan? I always save the best for last. Thanks for Dan Spinney for his ongoing support now and over the years. My team challenged me to do this. I'm not going to. I saw Morgan Wallen last week, the country star, and he ended every song with all right, I'm going to do it. Thank you. So thank you for all attending today. And again, if you need anything at any point, just give us a holler. Thank you, everybody.